The Bank of Canada did it. They increased the overnight lending rate again. This is the 8th consecutive time. It's going to impact many borrowers here in Canada. Let's dive a little bit deeper and see what they got to say. Hey, it's Andrew Holenchuk here. Victoria Property Group, eXp Realty. Let's dive a little bit deeper into this rate hike. Bank of Canada delivers quarter-point rate hike, signals pause to further increases. The Bank of Canada increased its benchmark interest rate by 0.25 percentage point, but said that it expects to hold off further rate hikes, making it the first major central bank to say it would pause monetary policy tightening. This is the 8th consecutive rate increase and brings the bank's policy rate to 4.5%. The Bank of Canada has raised rates rapidly and states now it's time to pause and assess whether its monetary policy is sufficiently restrictive to bring inflation back to the 2% target. Bank of Canada Governor Macklem said in a news conference. Furthermore, Governor Macklem states, to be clear, this is a conditional pause. If we need to do more to get inflation to the 2% target, we will. Shots fired. The bank lowered its forecast for inflation on Wednesday. It also reiterated that it expects the economy to stall in the first half of the year. Well, that's not encouraging, but does not foresee a significant recession. I always say here in Victoria, we are more isolated than most markets. We live in a beautiful spot of the world. The widely expected decision marks a turning point for the central bank. Over the past year, it has pushed Canadian borrowing costs rapidly higher to combat runaway inflation. Now, with the price pressures easing and the economy slowing, the bank has said that interest rates likely as high as they need to go. Fingers crossed, there's no more mortgage rate hikes. The bank now expects consumers' price index inflation to fall about 3% by the middle of this year and at 2.6% by the fourth quarter. It sees inflation returning to the 2% target in 2024. The annual rate of inflation remains well above those levels, clocking at 6.3% in December, but that is down from the peak of 8.1% in June. Price pressures continue to ease thanks to a drop in oil prices and improvements in global supply chains, plus the slowing effects on the economy of the bank's rate increases. Stephen Brown, senior Canada economist, Capital Economics, recently stated, while the bank did not rule out future rate hikes entirely, the new guidance reinforces our view that the bank's next move is likely to be a rate cut, albeit not until later this year. The expected drop in inflation comes alongside a slowdown in the Canadian economy. The bank expects to flatline through the first half of 2023 as higher borrowing costs squeeze Canadian finances and weigh on consumer spending and business investment. It's just as likely that we'll have 2 or 3 quarters of slightly negative growth as slightly positive growth, Mr. Macklem said. So yes, it could be a mild recession. It's not a major contraction. We do need this period, though, of essentially no growth to allow supply to catch up, he added. But I don't want to pretend that it's painless. It's not painless. So far, the Canadian economy has proven more resilient than expected. Unemployment is near a record low and consumer spending has remained relatively robust. But there is growing evidence that restrictive monetary policy is slowing activity, the bank said. Higher interest rates hammered the housing market in 2022. And consumers have begun to cut spending on big ticket items. The bank expects spending to slow further as homeowners renew their mortgages at higher interest rates and nervous shoppers trim non-essential purchases. The rise in borrowing costs is expected to continue to strain many household budgets. Interest payments on household mortgages are estimated to be about 4.5% of disposable income at the beginning of 2023, up from 3.2% of the beginning of 2022. The bank is intentionally using interest rates to slow down the economy and inflation. The goal is reducing spending on goods and services to bring overall demand in line with supply, which eases the pressure. The bank says that the economy remains in a position of excess demand. This is the most visible in the labor market, where unemployment is low and businesses continue having trouble finding enough workers. This is fueling wage growth and feeding through into inflation, particularly in the service sector. The bank has argued that unemployment will need to rise to get inflation back to target. With the pace of wage growth no longer increasing, the risk of a wage price spiral has declined. However, unless a surprisingly strong pickup in productivity growth occurs, sustained 4% to 5% wage growth is not consistent with achieving to the 2% inflation target the bank said. There are other risks to the inflation outlook, the bank said. Service prices could prove stickier than expected. Oil prices could also rise more than anticipated, depending on what happens with the war in Ukraine and China's reopening of the COVID-19 lockdowns. With me being in real estate, what I'm really noticing how much of an impact is having not only on buyers, but it's also having a major impact on a lot of my clients that own homes with their mortgage rates having to renew. I actually have a few listings coming up, sadly, that I've received phone calls from my clients that stated, geez, Andrew, my mortgage is up for renewal. And with these higher interest rates, with the bigger mortgages that we took out in the last 2 to 5 years, depending on which client it was, we now cannot afford our mortgage payments. So what the government's also doing is forcing some of these people out of their homes. With such low inventory, it's really creating havoc, not only on the buyers out there, but people that are having to sell and then having to rent, because the rental market is very expensive as well. So there's truly not many win-wins in our market. The government's going to have many new strategies to increase housing. We've been saying this for years, if not decades. We have a massive shortage. And what's the government going to do? That's what goes for federal, provincial, and local governments. We need to remove all the red tape to increase more housing. It shouldn't take 1, 2, 3 years to go through the development process with the municipalities. We need more housing. This is up to the government to streamline this. So I hope you found this informative. Please like, please share, please subscribe. If you have any questions or your thoughts, I'd love to hear it. All the best. Bye for now.